Welcome to day 43 of startup. I have two more co-founders joining most likely with me, and until now only I have been pitching to investors. Now they will also start pitching. So we have been discussing the elements of pitch, and one of the things that is very important for a startup is that it has to show $1 billion potential. Like it has to become $1 billion company one day in 7 to 10 years to even attract a tiny starting $5,000 investment. And why is that? So I just want to cover this today. So when you go to investors, okay, so there are actually multiple types of investors. First of all, so they are successful businessmen. You can take money from them and you can show them there is a successful business opportunity in your startup, so they can invest, let's say, $10,000, and your startup can make $100,000 of revenue in 3 years and start to build like 20,000 profits, which will scale eventually, and they can easily get back that money back from profits or by selling the company. That's all good, and you can get those investors to invest in your company. But very but in a but most of these businessmen, they are not in tech, and tech businesses work in a very different way. Tech, a software is a product that is so easy to distribute. If there is a software which is little better than yours, even if that company is sitting 1,000 miles away, it will take away your customer because they can directly download the software from internet or just log in into their cloud and immediately they can use it. So if you are not number one or number two, then no, then the third or fourth or fifth or any other number, you will not probably have a market. You will not be able to sustain yourself, you will not be able to compete. So the point is that software business, you can only become very big, or you will not be able to beat or sustain across the competition which is attracting a lot of funds, or which is growing very fast, or which has attracted a lot of resources because it was growing fast. So investors who are in the tech space, they are very different from the investors who are not in the tech space, who are in regular brick and mortar businesses. So tech businesses, then by nature, they are designed to grow very fast and become leader in 5 to 7 years. And investors who are in tech space, they know that. So so there are a couple of consequences for that, for this nature of tech business. And the first consequence is that like we all know, for a venture capital firm, if it invests in 10 startups, so let's say there's a venture capital firm which invests $10 million in 10 startups, then seven of them will fail and their money will go down. Three of them will actually be in a place where it doesn't go up, it will probably be at the same place, and only one of them will actually give 10x or 20x or 30x return, and this startup will be the one that will make up for all the losses in other startups. So for a venture capital firm, when it is looking to invest in your company, it is not just looking that whether your company will succeed, but it is looking that whether your company will succeed so big that it will make up for that 10 losses that it is making, or 9 other losses that it is making. So your startup has the responsibility not just to succeed, but to succeed so big, give 20x return to the investor who is investing $10 million, so that it, so I already explained that, right? So imagine now someone is investing $10 million and he needs 20 times return on that. So 10 into 20, how much is that? Okay, $200 million of return, right? So your startup's valuation has to scale like massively to give that kind of return. So now you can say that, okay, but I do not need 10 million investment, I only need $10,000 investment right now. Why do I really need to show a $1 billion company? Not for The reason for that is that most of the investors who invest $5,000 or even $100,000 or whatever smaller amounts, they are called angels. They only invest with the faith that one day you will be raising funds from bigger investors who will be investing $10 million, and they're called Series A investors. And at this point of time, most of these early investors actually get their principal back or even some return. So the angels will only be interested in investing in your company if they see the potential of getting a bigger investment one day. And so for this reason, the preference of a VC, a venture capital firm, trickles down to the lowest in the chain, the investor who is also the lowest in the chain. And so that for that reason, any company you start in tech, you are building a software, it has to have that $1 billion potential. And because of that, there are more consequences, and that I will cover in the second video after this, which will be tomorrow, in which I will discuss the structure of a pitch.